Hey guys, so in this video, I'm going over 7 of the top e-commerce stocks that you can buy in 2020. These 7 stocks are high performers in the e-commerce space, and they are poised for rapid or sustained growth over the next 10 years. Make sure to watch all the way through, as I'll do an in-depth analysis on each of these companies and why they might be a good buy and make you a lot of money. We've seen the rise of e-commerce over the last decade, with retail e-commerce sales worldwide increasing by over 3 times in the last 6 years, from $1.3 trillion in 2014 to an expected $4.9 trillion in 2021. The US and China are currently the largest e-commerce markets, with $561 and $740 billion in sales respectively in 2019. And with coronavirus, we've seen some major jumps in online sales in March and April. So this presents an opportunity and is right now the perfect time to invest in e-commerce stocks. Most companies are already up a ton. For example, Wayfair, which jumped from around $20 per share all the way to $170 in the span of 2 months. However, that does not mean that it's necessarily too late, as e-commerce is an industry which I believe has so much more potential. By the way, I want to give a shout out to my friend Jerry Romine, who makes amazing stock videos. We're actually reviewing the same 7 stocks, and I'll put a link to his video in the description below. He does a beast mode analysis and has a different way of looking at stocks, which I think you guys will find extremely helpful. So make sure to check out his channel as well. Okay, awesome. Let's go over the 7 top e-commerce companies who are set to grow rapidly in the next 10 to 20 years. So first up, we have Amazon, AMZN. Of course, we're starting with this one because really there's no other company that's perfectly positioned for the pandemic shopping needs. Amazon is currently trading at $2,409.78 with a 52-week low of $1,626.03 and a high of $2,475. This means it's only down 3% from its all-time highs. And year to date, it's up 28%. Right before coronavirus hit, we saw a big jump in its stock price, but the general direction of the market brought it back down in mid-March. And since then, it's recovered and even surpassed where it was before. Amazon has a market cap of $1.2 trillion and a beta of 1.35, meaning that it's just above average volatility. They currently have a PE ratio of 115.1, which is very high and shows that investors have already baked in this future growth into its current valuation. Its price to earnings to growth ratio is 2.22. And if you don't know what the PEG ratio is, it's basically the PE ratio divided by the growth rate of earnings. And in this case, we're looking at the growth over 5 years. For high growth companies, sometimes it is better to look at the PEG ratio over the PE ratio, just so that we can factor in their expected growth. Right now, Amazon has an earnings per share of $20.94, and their current price to book ratio is 18.25, which is quite high. In terms of profitability, Amazon currently has a profit margin of 3.56%, and this is after expenses and taxes. One thing I did want to point out for Amazon is its return on equity, which right now is 18.58%. This is quite good, and it's showing how effectively management is using assets to create profits. To calculate ROE, you take the net income and divide it by the shareholders' equity. Now, debt-wise, Amazon has a pretty solid current ratio of 1.08, meaning they have more current assets than they have current liabilities. And in the news, Amazon has been doing very well. Their whole platform covers household products, groceries, streaming, and even working from home services. In Q1, Amazon sales were up 26% to $75.5 billion. However, their earnings were under analyst expectations. Amazon also made headlines when they announced that they would be taking most of their Q2 profits and investing it on COVID-19 related expenses. While this did make the stock price drop, it is an investment on Amazon's future in the post-COVID era. And I do believe that this will help them in the long run. It's good for the company itself, and it's also setting a good tone for the industry as a whole. It's always interesting to look at analyst ratings. So currently on a scale of 1 to 5, from 1 being a strong buy and 5 being a sell, Amazon is currently at a 1.7. That means analysts do believe that Amazon is a buy, and the current price target for Amazon is $2,645.67 versus the current price of $2,409.78. I think Amazon is a good long-term buy, but I do think it is quite expensive right now. In general, I think most stocks are quite expensive right now, but you could wait for a dip and buy then, or you can buy some right now and buy more during the next dip. I mean, we don't know if there's a dip coming up, but it is definitely possible. Amazon is a strong company that will make you money if you invest in it in the long term. But it's really up to you when you want to allocate funds for investing in this company. Next up on my list is Walmart, WMT. Long gone are the days when Walmart is just a brick and mortar store. In fact, they have now taken a huge chunk of the US e-commerce market and are second to just Amazon. Currently, Walmart is trading at $125.94 with a 52-week low of $100.25 and a 52-week high of $133.38. Walmart currently has a market cap of $350 billion, a beta of 0.32, meaning it's not volatile at all, and a PE ratio of 24.27. If we look at their price to earnings to growth ratio, however, we can see that it's 4.07. Since all these e-commerce companies are projected to have lots of future growth, their PEG ratios are always lower than their current PE ratios. Walmart currently has an earnings per share of $5.19 and a dividend of 1.75%, so it is a mild dividend stock. Its current price to book ratio is 4.68, and in terms of profitability, their current profit margins are 2.84%. Just like Amazon, they also have a very high return on equity, currently falling at 18.86%. One thing that is a little bit weak for Walmart is their current ratio of 0.8, meaning that they have more current liabilities than current assets. In terms of profitability for the next quarter, we might expect to see something similar to Amazon. Since Walmart employs a huge amount of people, they will have to invest a lot of money in worker protection as well as other COVID-19 related expenses. So yes, this may hurt their profitability for this next year, even if their revenues and earnings go up a ton. So based on the analysts, they are saying that the stock is currently a 2, which means it's a moderate buy. They have also set a price target of $128.56, which is a couple percent above its current trading price. I think Walmart is well poised for the future with its strong growth in e-commerce, paired with the fact that it sells consumer staples that are currently in high demand. It definitely is a strong e-commerce stock, and there will be more future growth. All right, next up on my list is Mercado Libre. MELI. This is the biggest online retailer in Latin America and has seen tremendous growth with net revenues up 71% in the last quarter. This is an exciting company in Latin America just because of the possible growth that there is for e-commerce there. Right now the area is mostly cash-based, but with this pandemic, they are predicting that this will cause people to adopt online purchasing habits. So currently Mercado Libre is trading at $775.05 with a 52-week low of $422.22 and a 52-week high of $783.74. If we zoom out, we can see that there was a significant drop in March, but then a rebound back to all-time highs. MELI currently has a market cap of $38.5 billion, a beta of 1.55, meaning that it is relatively volatile, and earnings per share of negative $4.21. Their price to book ratio is 20.7, which is quite high. And right now their profit margin is negative 8.28% after expenses and taxes. Due to them losing money, of course, their return on equity is not good at negative 9.58%. However, their current ratio of 2.23 means that it is in a strong place financially. Recently, we saw a huge jump in their share price when they reported strong Q1 revenues. Now, no, I said revenues and not profit because their profit was negative. The cool thing about Mercado Libre is that it's also a fintech company. Since a huge number of people in that area don't have bank accounts or credit cards, their Mercado Pago payment solutions has done really well and become a popular way of paying for goods. It's very similar to PayPal in America. Based on analysts, they believe that this is a 2.4, meaning it's between a buy and a hold. They've also set an average price target of $658.38, which is 15% lower than its current price of $775.05. Mercado Libre will see continued growth, but it's no doubt that giants like Amazon will come into the territory and try and take a piece of the pie. There's a lot of growth potential in Latin America, but it really depends on whether or not you think a smaller company like this can beat out the giants when they do come and try and take over. Right now though, it does look very promising because of their advantages with their payment processing. Next up on my list is Alibaba, BABA. This is a Chinese e-commerce, internet, retail, and technology company. You've probably heard of AliExpress, which is owned by Alibaba, and this is a website where it allows you to buy goods from these factories in China for very cheap. Overall, Alibaba is the biggest e-commerce company in China right now. So Alibaba right now is currently trading at $203.68 with a 52-week low of $147.95 and a 52-week high of $231.14. Their current market cap is $545 billion with a forward PE ratio of 24.45. Their PEG ratio is a lot lower and it's currently at 1.25. If we take a look at the price to book ratio, we can see that it's currently at 5.14, which is comparatively low for these types of e-commerce companies. And they have a very high profit margin, sitting at 35.21%. Their return on equity right now is very good, sitting at 23.01%. And their current ratio of 1.75 means that they're in a very strong place financially. We can see that their revenues have been going through the roof in the recent years, with solid earnings as well. Analysts currently rate this at 1.6, meaning they're saying it's a moderately strong buy. They also set an average price target of $256 $202.50 versus the current price of $203.68. I really like Alibaba, and one reason is because I actually use them for my own e-commerce business. However, I also think that they have a lot of future growth ahead of them. The value based on the current price is pretty good, at least compared to a lot of the other e-commerce stocks which seem to be overbought. Yes, Alibaba is still overpriced when looking at just the numbers, but the reason why people buy these stocks is because of the future growth and potential. And with a stock like Alibaba, which has a lot of momentum, that current potential is looking pretty good. Next up is Shopify, S-H-O-P. And I actually included Shopify in a recent video, and since then it's gained tremendously. Shopify is an e-commerce platform that hosts e-commerce websites for all types of businesses. With COVID-19, it seems that Shopify is perfectly positioned to become the e-commerce platform that millions of small businesses use. So currently, Shopify is trading at $767 with a 52-week low of $262.17 and a high of $774.79. And it has just about tripled over the last year. Shopify has a market cap of $91 billion and a crazy high PE ratio of 970. Now, even if we look at the PEG ratio, this is at 23.46, which is still very high. So value investors will look at this and be like, there's no way I'm buying Shopify. Its price to book ratio is 29.62, which is also very high. And right now, the current profit margin is negative 7.65%. However, Shopify's current ratio is very good at 9.45. Analysts have rated this as a 2.5, meaning that it's just in the middle at a hold. And the current price target is $512.55 versus the current price of $767. So that's the only company on this list where the price target is much lower than the current trading price. Shopify's Q1 numbers were actually very good, with the revenues rising 47% year over year in the first quarter. In fact, in the last 2 months, we've seen a rise of 62% in the amount of Shopify stores, and it doesn't seem like momentum is slowing down at all. Overall, I still believe that Shopify is a long-term play that will see significant growth, one based on e-com growth in general, and also based on the fact that Shopify is the dominant player in this market. Pretty much everyone uses them, and they're just so good at what they do. So with a lot of these small businesses now currently transitioning to online, Shopify will be there to create all these new stores and should see a huge boost in the revenues as well as the amount of people that use their platform. However, Shopify does have a very sky-high valuation right now. Its whole price is based on its future growth and not on its earnings right now. Be careful with the stock in the short term, but I do think that in the long term, we should see significant growth. Okay, number 6 on my list is JD.com. This is a Chinese e-commerce company, and it's the second largest online retailer in China. This stock made the news recently with its excellent first quarter revenues and profits even during COVID-19. So of course, with China being one of the main centers of e-commerce growth, this stock is definitely trending. Currently, JD is trading at a price of $50.85 with a 52-week low of $25.48 and a 52-week high of $51.01. If we zoom out, you can see that overall it's been trending up for the last 6 months. JD's current market cap is $75 billion with a PE ratio of 345.92, a very high PE ratio. However, if we look at the price to earnings to growth, we can see that it's just 1.03. So a lot of future growth potential baked into this price. Right now, the current price to book ratio is 6.24, and they have a profit margin of 2.11%. They have a moderately strong return on equity of 13.4%. And right now, the current ratio is 0.99, which means they have just about the same amount of current assets as current liabilities. Analysts say right now that this is a 1.8 on the buy-sell scale, meaning that it is a buy. And the current price target is $49.60 versus the current price of $50.85. JD recently released Q1 earnings of 28 cents per share, which beat estimates of 11 cents per share. Though they took a huge hit to the revenues due to the pandemic, they saw a very impressive increase of 25% in the number of customer accounts in the last 12 months. The momentum is obvious as more and more consumers are relying on online retailers like JD.com for their purchasing needs. If you're looking for a good Chinese e-commerce stock, Alibaba and JD are both good long-term plays. Both have very high PE ratios, and value investors might find that very hard to swallow. But for momentum investors, these two stocks have a lot to offer. Okay, and number 7 on my list is eBay. And eBay, of course, is one of the largest e-commerce platforms in America. Chances are you've probably bid on something on their platform before. eBay is currently trading at $42.11 with a 52-week low of $26.02 and a 52-week high of $42.86. If we zoom out, we can see that there was a huge collapse in mid-March, but it's bounced back to all-time highs since then. Their current market cap is $29.5 billion with a PE ratio of 7.36. This is the lowest PE ratio on this list, and their PEG ratio right now is 1.41. So since eBay has been in the game for so long, there's not too much projected growth, at least compared to some of the other e-commerce stocks. eBay is a mild dividend stock with a dividend of 1.54%. Their current price to book ratio is 13.93, and their current profit margin is 43.49%. An extremely high profit margin. They also have a very strong return on equity of 48.13%. And their current ratio is sitting at 1.34. So based on analysts, this is a 2.6, meaning they think that it is a hold. The current price target is $40.69 versus the current price of $42.11. So just about equal. For quarter one, eBay reported adjusted earnings of 77 cents per share based on a revenue of $2.4 billion. They are expecting their Q2 numbers to be slightly higher, between $2.38 and $2.48 billion in revenue. Recently, eBay actually got a brand new CEO, and they also sold off StubHub for $4.05 billion. Yes, eBay is not as trendy as Amazon or Shopify, but it still is a very strong e-commerce platform with strong sales. It's not as cool as the other two companies, but their numbers look very good and they have an extremely high profit margin. Based on its recent numbers, we should expect eBay to keep trending up. So guys, those are 7 top e-commerce stocks that you can buy today. Lots of these e-commerce stocks are in fact momentum stocks and not value stocks. From a value perspective, most of these stocks are way overpriced just based on their current earnings and financials. Most of these companies have extremely high PE ratios, and that just shows that investors really believe that there's going to be a lot of future growth. E-commerce is not new, but it is still rapidly growing with a lot of room for expansion in the next 10 years. We should expect the industry to do extremely well, especially with how COVID-19 has changed consumer habits and forced more stores to create an online presence. In my opinion, a lot of these stocks are long-term buys, and I do personally invest in them. As always, you guys, these are just my opinions. Make sure to do your own due diligence before investing in any type of stock. If you want to see a more technical analysis, make sure to check out Jerry Romine's channel and see his very technical analysis of the same 7 stocks. But yes, I like e-commerce stocks because as an e-commerce seller myself, I see the huge potential and the untapped market that does exist. Hey guys, if you haven't signed up yet for WeBull, make sure to do that ASAP and get your 1 free stock worth up to $1,400. I personally use this platform. It's easy to use, very powerful actually, and it's completely free. And if you like this video, make sure to hit that like button and also subscribe to my channel if you want to see more videos just like this. I make tons of videos about investing, personal finance, and entrepreneurship. So that's it for today. Thank you so much, and I'll see you guys in the next video. Peace.